What's up, friends? It's Tess from WanderWealthy.com, your virtual money coach, and today we're going to be talking about taxes, but specifically how different type of investment income is taxed. Super exciting stuff. But if you're starting to get invested, or you're starting to think about getting invested, or you've been investing for quite a while but didn't realize there's different types of investment income and you have to pay taxes differently on them, then this video should help you out. If you're new here, make sure you hit the subscribe button. I love teaching people how to get started with investing or how to invest better. I love helping them build wealth, see how they can put their money to work for them so they don't have to work as hard, and I do it all in my free investing bootcamp. So if you want to get in and learn even more about investing, you can go to wanderwealthy.com/invest. I can't wait to see you in there. Okay, so last week we talked all about the 3 different types of income that investors make. It's funny, but I think a lot of us think about investing one way and don't realize that there's actually different ways that investors make income, not just buying something, hoping it grows in value, and then selling it. So if you need a full debrief, go ahead and watch the video that I will link over there, and then come back to this video and we'll talk about taxes. But if you're all caught up, then let's just do a quick review. The 3 different types of investment income are capital gains, dividend income, and interest income. And unfortunately, it's not a super cut and dry way of understanding how these different forms of income are taxed. They get split up even further, and then you kind of gotta decipher it. So here's your quick and dirty diagram. Hopefully I can figure out how to put a diagram on the screen. If not, let's just step on through it. We're gonna start with capital gains. Now, capital gains happen only when you actually sell the underlying shares that you own for more money than what you bought it for. Now, when would you do this? Either to capitalize on the gains that you've seen and go, okay, I've been owning these shares for a while, I'm ready to release them. Or sometimes it can happen through rebalancing. If you have a portfolio and you need to sell some high stuff to buy some low stuff, then you might incur capital gains. Now, quick side note, if you are investing in any sort of tax advantaged account, in the US that would be IRAs or Roth IRAs or employer sponsored retirement plans like 401k, 403b, TSP, 457, then when you're rebalancing while you're going through your investment journey, you don't get taxed on this. But if you're investing in a taxable account, then if you're investing or you're just selling shares that have increased in value, you're gonna have to pay taxes. But of course, you're gonna pay different taxes based on how long you own these underlying shares. So from the last video, we talked about short-term capital gains and long-term capital gains. Remember that short-term capital gains are gains that you receive from selling shares that you've owned for less than 365 days. Long-term are ones that you've owned for longer than a year. When you make money from selling shares in the short term, you're going to be taxed at your marginal tax rate. So however you're paying income tax, that's also how you're gonna pay short-term capital gains tax. Now, this might be all fine and dandy, but if you hold your shares for more than a year before you sell them, you get charged at the long-term capital gains tax rate. So I'll put the marginal tax rate table here and the long-term capital gains tax table here, and you can compare the two. Generally, you're probably going to be paying less in taxes on your long-term capital gains. Basically, the IRS is trying to incentivize us to hold on to our shares for longer and be long-term investors, which is something I approve of. Let's move on to dividend income. Just like capital gains, there are 2 different types of dividend income, specifically when it comes to how you're going to be taxed. There is qualified dividend income and non-qualified dividend income. Qualified dividend income are dividends that are paid out by US companies that are publicly traded on US stock exchanges. When you make dividend income, you are essentially getting paid money every quarter, or maybe just once a year, sometimes twice a year. It depends what pace the company or the ETF wants to pay you out at. But you're essentially making passive income. Now, if these shares aren't, again, sheltered in a tax-advantaged account, then you're gonna have to pay taxes on them. But the good news is, with qualified dividend income, again, you get to pay taxes using the long-term capital gains tax rate table. Now, you might not only be owning US companies. You could could also own some international equities that also pay out dividends. Unfortunately, since they're international and they're not traded on the US stock exchange, these dividends are considered non-qualified dividends. Basically, what's not qualified dividend income is non-qualified dividend income, and this income, yes, you have to pay at the marginal tax rate. Now, there's still lots of benefits in diversifying your equity holdings and not just owning 100% of the US equity market, so don't get too worked up about the differences in tax treatment. I just think it's important for you to know. And of course, if all of your equities, international and US, are wrapped up in a tax-advantaged account, usually a retirement account, maybe an HSA, then you don't pay taxes on these dividends because they automatically get reinvested and stay in that tax-sheltered account. The third type of investment income is interest income, but it's also income that you get outside of the investing world, like in your savings accounts. Any sort of interest income you make, whether it's in investments by owning bonds or bond ETFs, or it's by having money in your savings account, it's going to be taxed at the marginal tax rate. Actually, I should go over here. Now, there are a couple of exceptions here. If you own treasury bills, treasury notes, or treasury bonds, then you actually get to not pay state income tax if you live in a state that charges income tax. And if you own municipal bonds, like maybe in your state, in your city, you're trying to help the public library make an expansion, then you're generally exempt from federal income tax, and you can often even be exempt from state income tax. So those are some things to note, but if you're just investing in bond ETFs, then you can expect, as long as it's not in a tax sheltered account, to pay taxes at your marginal tax rate. Okay, so that's it. That's how the three different types of investment income is taxed. I know it can be confusing, but it's still such an important thing to understand. So if you have to, watch this again, or get really comfortable with investing and how you make money investing in these three different ways, and then come back here and understand, okay, now how is that money going to be taxed? And of course, if you want to learn more about investing and, start investing, you can join my free investing bootcamp by going to wanderwealthy.com/invest. I'm so excited because I'm about to launch my invested program where I go into much more detail about all of these things. So if you want to be the first to know, plus get maybe a special discount, then you're going to want to be in the investing bootcamp. So head on over there, and until I see you next time, I hope you wander wealthy. Bye!